Welcome to Sectors Up Close. I'm Elena Casas. Today we're talking shipping and my guest is Joachim Klement, Head of Strategy at Liberum Capital. World Bank economists warned this weekend that the disruption to shipping from Houthi attacks in the Red Sea could have far-reaching effects on the global economy, pushing up prices and reigniting inflation worries. On Monday, Qatar Energy, the world's second-largest exporter of LNG, was the latest shipper to announce its tankers will be going around the Cape of Good Hope rather than risking the Red Sea. That means delivery delays for customers and higher costs. This is the Baltic Dry Index, which tracks the cost of shipping raw materials. You can see a huge spike at the end of December, while the average cost of shipping a container from China to Europe has risen 114% in the last month. To find out what that means for shipping companies, I'm joined now by Joachim Klement of Liberum Capital. Joachim, hi, thanks for joining us. How much extra cost is imposed on the shipping companies by avoiding the Red Sea?
Well, the most important cost component is actually the time component, because it takes about 2 weeks to 20 days longer to ship those goods around the southern tip of Africa. And that means that your supply chain, especially if you are just kind of gotten back to a more normalized just-in-time delivery, is once again disrupted. In terms of financial cost, there's obviously the cost for that you have to pay those ships, the charge, and the insurance costs that have gone up as well. And these are what we see reflected in the Baltic Dry Index, where basically costs for transport have doubled, essentially.
This isn't necessarily bad news for the shipping companies, though, is it?
No, for them it's actually very welcome news, because they have seen during the pandemic, obviously, sky-high shipping rates. These shipping rates have collapsed as the supply chain disruptions have normalized, and now they get another little bit of a windfall game, at least in the short term for this quarter.
So what's the impact been on those stock prices?
They have rallied, and they have rallied the more the situation in the Red Sea escalated. We think that this entire situation in the Red Sea is going to be temporary in nature. It's probably going to be a 1 or 2 quarter impact or boost for shipping companies' earnings, but they still are a very, very attractive investment proposition for longer-term investors, because so much pessimism is priced into long-term earnings forecasts.
The volume of container ships going through the Panama Canal has also been seriously reduced in the last couple of months by the low water level, hasn't it? So is that, and that broader issue of climate change affecting water levels, potentially a longer-term problem?
Yes, the issues with climate change and what that means for the Suez Canal and the Panama Canal as the 2 crucial trade bottlenecks in the world is only getting worse. In fact, the Panama Canal has a lot of issues just from the very fact that it is at its basically limit to its capacity. And any kind of small disruption already forces a lot of basically pile up in terms of cargo deliveries between the west coast and east coast of the US. So these things are structurally getting worse, and any little bit will help the shipping companies demand higher fees of their customers.
Of course, these higher fees are good news for the companies in the short term, but more broadly, given the disruption they saw for years during coronavirus and now several major global problems, can the companies cope with this level of disruption?
Oh, yes, indeed. What we've seen over the last couple of years is actually 2 things. On the one hand, global demand for international shipments has declined as the economies in Europe, in China and in the US have started to soften and to weaken. And at the same time, in reaction to the supply chain disruptions, more ships have come online, and you basically are now seeing a little bit of an almost oversupply of shipping capacity that keeps prices low in the foreseeable future.
From an investor perspective then, which companies are best positioned here?
The two companies we really like are Kühne + Nagel and Moller-Maersk, the two major global logistics companies. The reason why we like them is because so much pessimism has been priced into their share prices over the last 6 to 12 months. To give you an idea, while these companies will not go back to the kind of earnings that they've seen in 21-22, what the market is pricing in at the moment for Kühne + Nagel is flat earnings over the next 3 years. So basically no recovery in global trade whatsoever. For Moller-Maersk, it's a little bit more optimistic, but still we're talking about very, very pessimistic assumptions about global trade over the next 3 years, which we think is clearly too pessimistic, not just because the economy is at some point going to reaccelerate, but also, as we just seen over the last couple of weeks, there can be all kinds of disruptions, whether or climate related or geopolitics related.
Joachim Klement of Liberum Capital, thank you so much for that analysis. And that's our look at shipping companies. I'm Elena Casas, and this is Reuters.